Is the stock market in a massive bubble? Or is this just the new normal? It feels like every time you turn on the news, someone is either screaming crash or telling you that stocks can only go up. The truth is, we are in one of the most paradoxical markets in history. Valuations are at nosebleed levels, yet they're being propped up by record-breaking corporate profits. So, let's break down the bull and bear cases to figure out what's really going on. First, let's look at the bull argument, the case for growth. The optimists will tell you, this is not 1999. And they have a point. Back in the dot-com bubble, companies were being valued on things like website clicks and eyeballs, with no real profits in sight. Today, the tech giants leading the market are absolute money printing machines. For 2026, analysts are forecasting around 15% earnings growth for these behemoths. It's not just a tech story either. Across the entire S&P 500, profit margins are hitting nearly 14%, the highest they've been since 2008. These are real, tangible earnings, not just hopes and dreams. Then there's the AI factor. We've heard about the promise of artificial intelligence for years, but the bulls argue we are finally in the realization phase. The hundreds of billions of dollars poured into AI infrastructure over the last couple of years are starting to pay off. We are seeing real efficiency gains in sectors you might not expect, like healthcare, logistics, and manufacturing. This productivity boom could justify higher valuations because it means companies can do more with less, boosting their bottom line for years to come. And you can't ignore the role of government and central banks. Policies like fiscal stimulus, even small things like tax breaks on overtime pay, put more money into people's pockets. At the same time, the Federal Reserve has been cautious about raising interest rates too aggressively. This combination has kept a lot of cash sloshing around the system, and that cash needs to find a home. Often, it flows right into the stock market, pushing prices higher. Now, let's flip the coin and look at the bear case, the argument for a bubble. Skeptics are looking at several classic indicators that are flashing bright red. Take the Buffett indicator, for example. It compares the total value of the stock market to the country's GDP. Warren Buffett himself said that when this ratio gets near 200%, you're playing with fire. Right now, it's sitting at roughly 221%. That's a 5-alarm fire by his standards. Another scary metric is the Shiller-Cape ratio, which looks at stock prices relative to the average earnings over the past 10 years. The current reading is near 40. To put that in perspective, that's the second highest level in history. The only time it was higher was at the absolute peak of the dot-com bubble, right before it imploded. These historical metrics suggest that stocks are incredibly expensive compared to their underlying economic fundamentals. Another major risk is concentration. A huge chunk of the market's recent gains has been driven by just a handful of mega-cap tech stocks. You know the names. This creates a fragile system. If just one of these AI heavyweights reports disappointing earnings or faces a setback, it could create a ripple effect that drags the entire market down with it. We saw a little of this in 2022, and the risk hasn't gone away. So, where does that leave us? Are we in a bubble destined to pop, or is this a new era of high growth? The most likely answer is somewhere in the middle. We are probably in what you could call a high valuation growth cycle, not a purely irrational bubble. A classic bubble involves widespread mania, where people are buying things they don't understand simply because the price is going up. Today, there's actually a lot of skepticism. High interest rates are also acting as a natural brake, putting some gravity on asset prices. This means the biggest risk for 2026 might not be a dramatic 50% crash. Instead, we could be looking at a period of valuation compression. This is where the market might go sideways, staying flat or even dipping slightly for a year or two. It's not a crash, but a slow, grinding process where earnings have to play catch-up to the incredibly high stock prices we have today. So, while the party might not be over, the music could be about to get a lot quieter. What do you think? Are we heading for a crash, a grind, or another leg up? Let me know in the comments below. Thanks for watching, and if you found this helpful, be sure to hit that like button and subscribe for more deep dives into the market. See you next time.